Morning traders. Today we are going to speak about the mechanical trading plan. How they design and develop and write a mechanical trading plan. There is a few components of every trading plan. Every trading plan is different from one person to another, even if they're trading the same securities, but it's different because they have different trading parameters, different risk management. Everybody's comfortable with different levels of risk. So let's talk about the first part of a trading plan. A time frame. A time frame. What are you trading? Are you scalping a 5-minute chart? Are you day trading to where you open the trade in the morning and you don't close it until the closing bell? Or are you swing trading? Swing trading is you buy today and you don't have to sell until tomorrow, after tomorrow. Whatever it is what is your trading frame and what are you comfortable with? Swing trading is usually for people they have a small account, less than $25,000, and they have a margin account. A small margin account, swing trading works for them because you can make money without hitting that 3 trades per week. You buy today and you sell tomorrow, it doesn't count. But once you go into the scalping and day trading, it does not really work for a small margin account. You either have to have more than $25,000 in that account, or you have to have one of those platforms, proprietary trading accounts. So, scalping. I warn you, anything less than the 5-minute chart, anything like the 1 minute, the 2 minutes, if you're trading the 1 and 2 minutes, you are fighting an uphill battle. It's very difficult to make money. Yes, people sell it online. Yes, people will sell you a strategy for $6,000 based on a 1 minute and 2 minute, and they're pretty much looking to entertain you. It's very difficult to execute anything on the 1 and 2 minute because it's very volatile, does not have to have any pattern. The longer the time frame, the more significant the move. The longer the time frame, the more significant the move. Nothing less than 5 minutes really worth your time, because otherwise you're going to be very inconsistent. I guarantee you, if you're trading the 1 minute and the 2 minute, you are losing. You are one of those consistent losers. And if you are not, please comment below. Let me know how you are actually being consistently profitable trading the 2 minute or the 1 minute time frame. All right. Number 2, risk management. If there is anything you're going to learn from this video, or you're going to take away from this video, is risk management. Risk management and stops go hand in hand. Risk management is a thing that you say to yourself before you even trade. So all of these stuff right here, all these 4 right here, is decided before you even open your position. This is before, and this is after. The 3 on the bottom. So let's talk about the before and after. Risk management is before you go into the trade. You're gonna tell yourself, or you're gonna write it on your plan, that my risk per trade is, for example, $500. So $500 is my risk per trade. What does that mean? If I'm scalping, I'm gonna decide that I'm not gonna lose more than $500, and I'm not gonna open more than 500 shares position. Where does that put your stop? $1 per share. So you decide you are not gonna lose $1 per share for a scalping trade. What if you're doing a swing trade and you still your risk is still $500 per trade? So what happens next? So if you're doing a swing trade, it's very unreasonable to do $1, especially if you're trading a big stock like Tesla, for example. So Tesla is going to hit the $1 like crazy. So you can say, okay, we're going to put a $10 per share a stop loss. A $10 per share is going to give you only 50 shares of Tesla for a swing trade. That's the difference. You have to adjust your position size based on your risk management. And maximum drawdown per day. When are you going to stop trading today? If you're having a bad day, when are you going to stop? So let's just say your maximum trade per day is $500, but you're only comfortable with $1,000 loss per day. $1,000. So all you can do today is 2 trades. And if you lose both trades without making any winning trades whatsoever, your maximum losing trades per day is 2 losing trades, and then you can stop trading for today and come back to it tomorrow and reapply your plan. Third one is conditions. Conditions is, again, this is decided before you even go into the trade. What kind of trader are you? Are you the trend following trade like that? Are you the reversal trade, so you wait until it comes down and then you start shorting it? Are you the range trade, which goes more like this? You buy at support, you sell at resistance. You buy here, you sell here. What kind of trader are you? And whatever you choose, decide that this is your way. Now it's difficult to just choose one and stick to it. Sometimes you can choose one and stick to it, and you're gonna master it. But to make money, you need to have at least 3 to kind of like, use all of them. Now there's 2 things you have to be careful of. Too little is not gonna make you money. Too much is gonna confuse you and distract you. So you have to have, where is your comfort level? I would say 2 to 3. 3 is a sweet number for most people. All right, the markets. I have seen people with charts on their screens. They have screens like, 80-inch TVs with like 30 different charts, and they got the crypto section, they got the forex section, they got the stock section, they got the options section, and it just continues like that. That TV is full of charts, and I have no idea how they even make money. I assume they don't. They're just doing that for just the entertainment part, especially if they're like, they are YouTubers trying to sell you their way of making money, turning your $800 account into $6 billion in like 3 days. That's what it is. You have to choose what market are you gonna go into. Are you an options trader? Are you a crypto trader? Are you a stocks trader? What options? Or are you a forex trader? What charts are you going to use? What markets are you going to actually trade? And stick to it so you can become more familiar with that particular market. And here's an example, or here's an illustration. If you have a dance partner that you go to dance with every weekend for the last year, you and your partner are going to be more harmonious together. You're going to expect your partner's moves. It's going to be a lot more smooth, easy, fun dance. But what if you go to the club one day and you start dancing with strangers, and you got 4 different strangers you're dancing with? Every time you dance with one partner is completely different from the other one. It's going to be controlled chaos. You wouldn't know, what they're going to do next because you're not familiar with their moves. That's exactly the same way. When you choose one market and you stick to it, you're going to understand that market moves a little bit better than just randomly go into different markets and just dance with them. So, 5, entries. Entries is pretty much based on conditions. Remember, these 3 right here is trade execution. Those 4 right here is pre-trade planning. These are pre-trade planning. This right here is trade execution. So let's talk about trade executions. Entry. When are you going to enter and when are you going to exit that trade? Entry. Are you using patterns? Are you using entry indicators? Are you using fundamentals? What triggers you to actually open that position? What triggers you to click on the buy button? And there's different patterns. We can definitely talk about different patterns in different video, but there is, you can find one that you're comfortable with based on the trend following, reversal, ranging indicators. Are you using simple moving average or something else? Is it the 21? Is it the 200 moving average? Is it the 8 moving average? Are you using like the fast, medium, and slow moving averages? Doesn't matter what the number is. Are you using it based on a scalping or based on a day trading or swing trading? Fundamentals. Fundamentals doesn't really work for scalping. They do not work together. I'll tell you why. Doesn't matter what this company's guidance is and projection and what's going to happen in the next 3 months is not going to change the price in the next 5 minutes. So fundamentals is more based for swing trading. You're waiting for the earning or the CEO to say something or an announcement of some kind. So whatever fundamental analysis you're using is a lot more appropriate for swing trading, not scalping or day trading. I would say not scalping. Scalping is more appropriate because, in the next 5 minutes, things are not going to change a lot unless you're waiting on that guidance or, standing there, watching TV, watching the chart, and as soon as they say something like the Fed announcement, for example, you just jump into it. This is the only way a fundamental reason is going to change within a 5 minute bar. So be careful there. Alright, stops. Stops go hand in hand with your risk management. If your maximum loss per trade is $500, where are you going to put that $500 stop? Are you going to put it bar by bar? Or are you going to put it where the simple moving average is going up and down and then suddenly the bars violate that moving average? Where are you going to put it and based on your maximum loss per trade? Targets, profit targets. I cannot believe how many people go into this, going to the moon kind of price action. I never understand that. I guess at some point I was a victim of it. But you buy something for $1 and you think it's gonna go to the moon. Elon Musk comes on a tweet saying Dogecoin is gonna go to the moon, and you think that you buy it for 6 cents and it's gonna go to whatever the moon is, and you never book any profits and it goes against you, and boom, your stop losses are hit. That's if you have a stop loss, or you just completely wipe out your account. There's nothing goes to the moon. Listen, a businessman, a car dealership owner buys a car for $20,000, sells it for $21,000, books $1,000 profit. A sandwich maker, the sandwich costs him $5, he sells it for $1, he books a $1 profit. A drug dealer, he buys his drugs for $5, sells it for $10, he books a $5 profit per sale. Doesn't matter what you're doing, you have to have a target or a profit objective, and trading is no different. You have to understand when are you going to have that either fixed or trailing stops. Fixed target objective is you're going to say 1 to 2 risk to reward ratio, 1 to 3. So for every dollar risk, I'm expecting to make $2 or $3 or $4. So every time you hit that level, you are booking profits. So for example, the chart is going this way, and then it goes this way, and you buy here. This is your buy, this is your stop. Where are you going to take profits? So this is, let's just say $1 here. So it goes 1, so you book 1, 2, 3. You book in profits as it goes up. Yes, you're going to leave money on the table. If this thing shoots all the way up to a $10 profit and you're already out by 3, that's absolutely fine. You booked $600 for only a $300 risk. As long as you keep your profits twice as much as your risk, you're going to be a successful trader. So do not expect it to go to the moon, because what happens sometimes is it gives you some money and then it tanks, and now your profitable trade becomes a losing trade. You don't want that. All right. Join our trading club at www.daytradingfans.com.